Ladies and gentlemen, this is Ifa Farouk here again with a new edition of another video that I'm going to shoot that'll hopefully give you more knowledge into the markets and help you trade binary options better, more effectively using primarily price action. But as you know, we are going to be doing, or not we, I am going to be doing a video series that will kind of take you step by step into different functions and make you become an expert. Now, this is going to be a little longer than the daily videos. So that being said, I want to make sure that everybody realizes that there are a bunch of groups out there. They all teach different things, which is fine, and none of them are wrong. But you have to also understand that one of the main things you need to learn is price action, regardless of the fact that it doesn't work 100%. Indicator-based trading without price action works less, in my opinion, than 70%, even less than that, maybe even less than 50%, so you're at a loss. And people use it wrongly. They don't use it the way that it's intended to be used. So we will be adding a couple indicators in here very soon, but I want to make sure everybody here is an expert at price action. An expert doesn't mean you would win 100% of the time. Expert means you are able to identify what is happening with the market just taking a look at it. So again, I have here Audi JPY. I have no idea why I keep using it. I just use this chart for some reason, but I'm going to use it again. And today's video is going to be about basically where to take a trade, when to take the trade, and when not to take the trade, or where to take the trade and where not to take the trade, based off of purely price action. So let's get started. I'm going to basically show you how this AUD, this is, I don't even know when this was July 14th, and we're not going to go through the whole thing, but I'm going to give you a few examples as to how you can place a trade. Now, I'm also going to do another webinar about trend lines. Okay. Now, I don't frequently use trend lines myself. I kind of like to stay consistent and just try to master one thing at a time. And in this case, it's going to be price action using horizontal lines. So when and where to take the trade and when not to. So let's just say right here, there's a bunch of mishmash happening. Now, you don't want to take any trades here yet until you figure out exactly what's happening with the market. So let's just say, you put a line here. This is the bottom of this minor trend, and I'm going to show you where you should and should not take a trade depending on what the candles look like. All right. So you have to make sure you look at all these wicks and all these different parameters when trading. So this area right here, this region right here, is the consolidation region. Okay, it looks like it's consolidating, not doing much of anything. It's just doing a bunch of hoo-haws. So let me see if I can get a hollow. I don't even know if I can. Select. I don't want a color. Black. That works, I guess, but then okay, so this area is kind of consolidation. You see this region right here is just going up and down, bouncing off of a unknown point. However, you can guess what the point is just based on putting the line. Now, how do you guess a point when it's consolidating like this? Remember, there's going to be ranges, there's going to be consolidations, meaning ranges, and then there's going to be trends. So you try to connect as many of these wicks as possible as the possible bounce line, and in this case it looks like it's approximately here. So in one of my videos I mentioned that you should wait, and if it's a consolidation area, you should wait till to see if there was a wick previously. If there was, then you should trade after you see the wick. But in this case, I mean, you don't know whether this right here is going to shoot up or go down. That's a risk you need to take. You need to be able to take to be able to find out. But if the likelihood is, if it does it once, if it does it twice, it might do it a third time, especially if the wicks are long and is bouncing off sharply. So you can be one of two type of traders. Okay, you could be a trader that waits till the candle closes close to support or resistance. Okay, or you could wait till it touches and then place a trade. Or you could be wait till it touches, wait till it goes down a little, and then place a trade. So the risk tolerance is, if you wait for it to close, that's less risky. If you wait for it to touch, that's a little more risky. And if you wait for it to touch and then go down a little bit and then place a trade at the most lowest point, that's even more risky. However, the last part is also the most profitable. More opportunities will arise doing it that method, but remember, it is more risky. So in this case, I'm going to show you an example of the 3 trades you could have taken. So let's say you have this huge wick right here, okay, and it bounced off. You haven't placed this line yet. You don't know if there's a consolidation or anything like that. So far your lines are over here. But let's just say it starts doing this stuff, and then it goes up and it bounces off again. Okay, so now you have a place where the price is bouncing off, and in that case, it would be right. I hate when that happens. Right here. Okay, and then it bounces back here, and then it bounces from up here again. Now notice that there was a wick over here, so you could have placed a trade either right when it touched to the downside for 15 minutes. Remember, this is a 5-minute chart. Right when it touched to the downside for 15 minutes, because you saw that it was bouncing up twice. Now remember, the sharper the bounce, the better it is. So see here, when this candle formed, it started right here, came up all the way here, meaning it was a green candle while this was forming, came up all the way here, and sharply went back all the way down, became a red candle, and closed lower. So this was a green candle until it bounced off this point. And then it came back here, and this huge green candle formed, but then right when it touched, a huge red candle formed, meaning there was a sharp pullback of that price. So then now you're saying to yourself at that point of time, like, okay, if it touches again, it's going to be a sharp bounce back. If there are large wicks previously, then you might want to trade at the touch or above it because of the wick. If it closes here constantly, and then bounces back, then you might want to wait for it to close and then place the trade. Okay, now I'll tell you the benefits and downsides of placing both types of trades, all 3 types of trades. So let's say you're here and it touches this point. You wait for it to touch, and you place a put option for 15 minutes to the downside. This would have been 5, 10, 15. You would have been in the money at the trade, because remember, under this line, right when you touched, you put a put option. Okay, so you're confident that it was going to go down. If you waited for it to come up a little bit, because you saw this wick, you thought there was going to be another wick, and you saw this coming up, the upside to that trade is that you are at, if it does in fact bounce over, the upside of that trade is that it will bounce under, and it will never touch that until this resistance point is over sometime in the future, and in this case all the way in the next day. But the downside is, if it goes up, remember when this touched, this was actually a green candle up. Well, this looked like a green candle, so you don't know at that point whether it's going to start doing an uptrend and breaking this line. You don't know that yet. So taking a put option at that point is risky because you don't know. The only thing that's holding you to taking that trade is that the fact that you had 2 bounces here, so you had to be confident that this is going to bounce again and create a wick. And in this case, if you had waited for here, you can see that regardless of how long your trade was, you would have been in the money. Okay, you could have placed 5 $100 trades in this section right here, from the touch till up here, and you would have profited all of them because none of them closed over that line until the next day right here. And then the next type of trade is waiting for the candle to close. So for example, it came up here, it closed right here. Okay, it touched, but then it closed here. So you're waiting for the close of this candle to make a trade. And then you did a put option, which would be retarded in my opinion, because look how far that close of the candle is from the resistance. So you don't want to place a trade like that, especially to the downside, because it has so much room in the future to move up and close very close to that line. But remember, the higher up that you place that put, the more likely your chances are. So that was what the first thing I said was, This is more risky, but it is also very profitable, and it would make you a lot of money if you implemented it right. So let's look at another example of a closed trade, one that you should take if you were a less risky trader. So we're looking for support and resistance points, and okay, so this is a good one right here. So this consolidation happened. You're in this time point right here. You're just watching to see what happens, and then it hits this point right here, and it kind of bounces up. Okay, and then it comes back here. It touches. Remember, this is an example of a open close trade, meaning you're waiting for the candle to close before you take the trade, and what it should look like. And in this case, it comes down here. And when this candle is forming, you see that not only it touches, it goes down. So this is a big red candle at this point, and then it goes back up and it starts to close here. As soon as you see, maybe like a minute before this candle closes, you see that it's about to close close to this line. You can place a 15-minute trade to the upside. Okay, so basically you're looking for trades where there's a area of resistance or support, and the candle closes close, very close, or right on that line. So let's look for another trade here. Let me remove all these drawings here. And remember, price action should never be used on its own. That is very risky, and you should always use it with indicators, and we'll be going through indicators later on in this tutorial course. So let's look at this ranging market. As you can see, the price hasn't been doing anything much in terms of trend. It has been kind of ranging within this area that I'm highlighting here. It has been ranging here. So now what you're looking for is you can either take calls or puts within this range, but remember, at some point, at some unknown point, it could the trend or the range could be exhausted and something else could start happening, and that time could be the time you decide to place a trade and you could lose. So just keep that in mind when you're doing these type of trades. So there are two trades you can take with this strategy that I'm about to show you if you're a candle close trader. Now, to reiterate, when you find a good area of support and resistance, you could either trade right when it touches that area, that line. You could trade by waiting a little bit before it goes up or down under the support or resistance and then placing that trade, or you can place it at the close of the candle so you know what's happening. So first rule is, if you're an open close trader, if you're waiting for the candle to close, if it closes above that line, not in this range, not in this type of market, because remember, it closed here in this case, and it came down, bounced again, and it closed here again. My general rule of thumb is that if it closes above and it penetrates even a little bit that line, I will not place that trade, because I don't know whether that trend is going to continue going up. However, if it closes directly under resistance, for example, I'm talking about resistance, I'm not going to talk about support for now, I'm just going to talk about resistance. If it closes close to that resistance line, and you know that that's a resistance line, then number one strategy is to take a 5-minute put option right at the close of that candle, meaning the opening of the other candle. Okay, and then you would have been in the money. So let's take a few examples. So this was an established area of resistance. So when that came back up here, see how close this candle, this green candle, closed to this line? You want, because this is a 5-minute candle, wait for about 30 seconds before this candle closes and just keep watching it to make sure it closes close to it. I usually close trade it even if it's a little closer. But then right when it closes, you take a 5-minute put and see that 5-minute would have expired in the money for you. This is a red candle. And then it continues going. Okay, so here again it closed close to this candle. You waited for the close, i.e. the open, before you placed the trade to the downside again for 5 minutes, and you would have been in the money again right here. And then again, it closed very close. In fact, it touched this line. It closed on the line, and then you would have placed another put for 5 minutes, and you would have been way in the money again. Okay, so there's an example. And then you continue going this way and see how close it closed again to the resistance. And then right when it closed, you could have done a 5-minute put option, and you would have been in the money. And that's number one strategy. Number two strategy is doing a 15-minute option, but you can obviously go through that yourself and see that, you know, where you could have been in or out. I recommend 5 minute. If you're doing a 5-minute candle, do the 5-minute strategy with this. And then again, it touched, it closed very close, and then you do a downside put option. But see here, this candle came up and it closed far away. You wouldn't want to take that because you know that it might come closer here and you would have been out of the money. So let's look at a candle where there is a long wick, and then whether you should take a trade there or not. Okay. Now this kind of works even if you're looking at small trends like this. So let's remove all these drawings again. Let's take this for example right here. So this closed right here. This is, you're still established now. You established a support area right here, and it went back up over here. I'll put it right here, and then when it came down here, you see that it closed right above the support line. You could have placed a 5-minute trade to the upside, and you would have been in the money. Okay, so now here, see this? Touch traders would have taken this trade and they would have won. But let's just say you're a open close trader. So now I'm labeling all these in different terms. Okay, so let me open up a PowerPoint real quick and kind of try to illustrate for you the difference between all of this. Okay, so alright, so I'm just gonna grab this drawing right here. I'll just grab this actually. Actually, I'll just duplicate this slide right here. Duplicate slide. I'll put this shit all the way in the back right here. And okay, so if you trade, if this is a strong level of resistance, and this is the support right here, this is support, a touch trader would take it right here. Now I'm labeling these so you know the difference. Okay, I'll delete this. Why do that? Okay, so I just kind of paused it and created something for you guys to show you the difference between the different nomenclature that I'm using. A touch trader, let's just say this is resistance right here, the resistance line, this is support, but none of this is touching support. But let's say the candle looks like this. A touch trader would take, if you know that this is a good point of resistance, would take the trade right when it touches the line. Okay, a wick trader would wait for a wick to form. If there's another wick, then you would wait for a wick to form and take a put option right at the top of it. This is the riskiest method there is, but it is the most profitable. And a close open trader is when that person waits for the candle to close and then waits for the other candle to open. Right at that transition time, you have to be really quick to take another trade. So that's basically the example I'm giving you here is open close trader. See, you have established that this is a point of resistance, a support. You don't know whether it's strong yet. You could, if you want, wait for this candle right here before you decide that this could be a good place of support. Now, see, this is a little far. It's about 20 pips from this location. You could take it from here if you like, but if you're a little less risky than that, then you could wait for this one right here. Wait for it to kind of touch, close, and then see how far it is from closing. It's almost exactly the same. So you could just take this one as a call option for 5 minutes, and you would have been in the money for that one. Okay, so this one came a little far, but I mean, you wouldn't want to exhaust the opportunities that you have. Now, pretty much every single support and resistance, almost every single one, has this type of rationale. So, for example, look at this minor pullback here and then a strong pullback here. You would have thought that maybe this will go all the way down, but see, even the slightest support line will have the slightest call option. So you could technically wait for this to close and then take a call option here. You probably would have been at the money, meaning your investment paid back fully, and then maybe place another trade here and had a call option. But I mean, I wouldn't take these trades right here. So let's look at another one, right? No, that's not a good one. Here's one right here where it came down, it bounced up sharply, and then when it came down here, waited for it to close, saw how close it is to that line, and maybe made a decision to do a call option for 5 minutes, and you would have been in the money with that one as well. Now, if you're following the rules, it's all about rules here and following the rules. If you waited for this one, it came down all the way here, your rules should tell you that if it's, 20 to 30, if it's over 30 pips off, then I'm not going to take it. And if this is 30 pips off, you shouldn't take it, even though it ended up going all the way up. You have to stay disciplined in this regard. Even right here, see how this opened here, and if you saw this bounce here, then maybe you put a resistance here, and then it bounced all the way here. So when it came back and closed right close to that candle, you could have done a 5-minute put option, and you would have won that as well. Okay. Let me give you this example. See here, it kind of went up, closed here, and it opened here and went back up over here. So then it came down and it touched this part. You wouldn't necessarily want to take this trade because it's already come down. It's already came up this much. So you don't know whether there might be another red candle here that will, because if you're doing a 5-minute call option, you're waiting for just one more candle to see what it looks like. So if it's a green candle and you do a call, that means you've won. If you do a put option, it has to be red. The next candle has to be red for you to win. But you don't know if it's pulled back this much off of this support. You don't know whether there's going to be another red candle that will come close here. So you wouldn't take that kind of trade because it's already pulled back up this much. Alright, you'd want to wait till it touches or closes very close to that line. Okay, so let's continue here and look for more trade setups. Okay, now I mean, these are all resistance lines. So let's say you put a resistance line here. If you're an open close trader, you wouldn't even take these trades because it didn't close close to these lines. I mean, if your risk tolerance, you see this green candle that I'm highlighting here closed at 255. This resistance line was at 261. If your risk tolerance is 60 pips like it's showing here, then you would have taken this trade because it follows your rules. But if your risk appetite is 30 pips, then it didn't close 30 pips under this line, so you wouldn't even take this trade. So none of this really matter right now for my purpose, because I think it's pretty self-explanatory when I say touch trader or wick trader, and I can pretty much tell you that I'll elaborate in my 15-minute strategy, which has worked amazing for me. I will show you how to do touch and wick trades, but right now I want to do open close trades. So see here, it kind of bounced up, it created this support here, it came down here, and it closed very close to that old support line. So you could have done a call option for 5 minutes, you would in the money. So you want to wait for, when you draw your lines, you want to see if that price is going to come back to that line, and then if it closes close to that line, you could place another trade for the next candle to go into the direction that you want it to. Okay, so let's say another one here. So none of this here has happened. Let's say none of this stuff has happened here. So let's go a little back. And let's say this is all you've seen so far. You've seen that it came down and it came back up sharply, which is indicative of a potential support. And then what you want to do is you want to wait for to see what happens when it approaches this candle again. Okay, so it's coming down again. Now you see this. Okay, you see not only did it close very close to that old support, it also has this long ass wick and it pushed back up. That indicates that the next candle will be a bullish one, or could be a bullish one. And in this case, if you put a 5-minute right at the end of this candle, if you put a 5-minute call option, then you would have been in the money. Okay, now you do not, if it closes, if this red candle, I have to look for an example. I can't really tell right now. There's an example of one trade that you should not take. I'm trying to figure out where I can see that. Okay, so basically my point is, if this candle, this one I'm highlighting here, came, and then forget about this red candle. Let's just say this was a green candle, okay, and it touched the green candle, this support line, and it went back up and it closed higher above. You do not want to take that kind of trade, all right? Because it's already closed way high above that support line. You only want to, if it's a support, you want to wait for the red candle to come closer to the support. If it's resistance, you want to wait for the green candle to come close to resistance. Okay, now this strategy is an amazing strategy because you can just back test the fuck out of it and you'll see how many times it works. So here's another level of support. Now here's another minor one. All these minor ones will have your chances of very high success rates. So this downtrend happened and it kind of consolidated up and then went back down, and see how close it closed. You could have done a 5-minute call option and you would have been in the money. And then it comes down here, it closes here, so that, and it comes back a little bit. So you saw that this is a potential area of minor support, and then it comes down and it closes on that line again, indicative of another call option for 5 minutes, and you would have been in the money again. Okay, so going down, and then right here again. It closes here, sharply goes back up, and it comes back down, and it closes very close. Depending on your risk appetite, whether you want to take this or not, it does go over the line a little bit, but it closes right close to that candle. So that line. And then you do a 5-minute call option, you would have been in the money. Okay. Can we do this one right here? Okay, so say this one right here. Now see, this was an area of support, and then this came down and it closed close to this. Okay, this is why I tell you, the closer to the line, the better the trade might be. But this was about 12 pips away from the support, so you would have lost this one. So you already know that this is not a 100% strategy, but it does work a lot of the times. But you can't just take this lesson and go out and practice, do this market. What you have to do is you need to go into the charts and look at the opportunities there were and draw wins and losses. This is where you would have won, this is where you would have lost, and that's just following it blindly with no indicators or none of that stuff. Okay, so that is that. Let me look for another example here. Okay, right here is a good example. So this came up right here and sharply went back all the way down here. Now you wouldn't trade anywhere here if you were an open close trader. You wouldn't trade anywhere here at all. Okay, if you were a wick trader or if you were a touch trader, you would have traded all these and you would have won every single time. Okay, but if you're an open close trader, you would have had to wait till here till it closes very close to that resistance before taking a 5-minute put and then winning and in the money. Same thing here, close right here and then being barely in the money here. If anything, at the money, it would have been at the money, meaning your investment back, or you would have won that. You wouldn't have lost it. And then it sharply declines again. This one you probably wouldn't take because it went over by about 20 pips. If depending on your risk tolerance, you may have taken that. I'm not really sure. And then let's continue, see where this goes. Okay, now these strategies, I don't know who's teaching them. I learned this by myself, analyzing the charts. Now I see all these people giving shout outs to people that you're teaching indicator based strategies, and I'm only laughing because you can find that shit for free on the internet. I know about all this stuff based on free education that I received on the internet, and I know more than these guys. Honestly speaking, I'm not even bragging. I just do because I listen to their webinars and I'm like, I already know this stuff, man. I don't need to sit here for hours just watching it again. This is what you need to know, people. This is what you need to know initially, and then you get more advanced. You can't start with just talking indicators and stuff. You don't know what the hell you're doing. You can't do that. So see here, let's say for example, you see a downward trend and then a good move up. Okay, now you're expecting the next time it comes to this area to close close to this line, and if it doesn't, you do not take the trade if you're an open close trader. And when it does that, see, it closed far below it, so you wouldn't take that trade, and for good reason, because it came back all the way down here. Okay, now that's where the risk part for a wick trader or a touch trader happens. If you're a touch trader, it's more risky because you would have just done a blind trade to the call side. Excuse me. Right when it touched, not knowing that it's going to continue down. If you're a wick trader, you wouldn't have taken this trade because there was no wick at the initial establishment of the support. Okay, so then it goes down and continues. Here's another one. It came down up here, came down, and see how it closed right at the support line. If you'd done a 5-minute, unfortunately, if you had waited for the opening of this candle, you would have won. But if you had placed a trade right at the closing of this candle, see how this price opened lower, so then right automatically you would have been out of the money and you would have lost. However, you can just supplement that by doing another call trade and you would have won the next one. And I guess you get the point. Go back in the charts, practice this, look for other trades where you create a support resistance, and then look for other opportunities where it came down, came up, and then right at the close of it, if it came close to it, it went down again. And just think about the potential. If you have a 5-minute trade, a 5-minute chart, and did a 5-minute trade, every one of these candles, if you did a 5-minute trade here, it depends on what this candle looks like for you to win. If you do a put option, this has to be red. If you do a call option, it has to be green. So that's basically a determinant of how you will win or lose your trades. Hopefully you guys enjoyed it. Hopefully it wasn't long and I can post it on Facebook. If not, good luck. You know where to find me. We'll go through a Q&A one day. We'll do a hangout when my shit starts working. If you have any questions, you know what to do. Like and comment on this video. I like the participation. I like the involvement in this group. And those people that aren't, I'm keeping a track of people who are watching these posts and not doing anything with them. I promise you, if you're watching this and you're one of those people, you will be deleted from the group, because I'm providing you information here for free that will make you money if you practice it properly. None of the other groups or anything will guarantee make you money, because all they want is money. I don't need your money, and I'm giving you money. I'm giving you information for free. If you are not looking at this and you're shouting out other people in other groups and all that stuff, and you're not doing that same thing here, then you're out of this group, period. Anyways, I don't want to be rude, but that's just the way it is. Hopefully you guys enjoyed it. Hopefully you guys learned something new. If you have any questions, you know where to find me. Take screenshots, ask questions, and I'm always here with the other group members, and we're all here to help, and let's just create a community and educational environment. See you guys later.